Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. Now, when we think about car crash companies of recent years, WeWork has to be close to being number one. WeWork's big downfall was rapid expansion encouraged by investors such as SoftBank, who gave the company billions. WeWork bled cash on this expansion, as well as luxurious offices and cult-like company parties and retreats. In 2019, investor pressure led WeWork to withdraw its IPO application over concerns about lack of profitability and corporate governance. The CEO resigned but walked away with billions, including nearly $1.7 billion from SoftBank, just to ensure he would cut most of his ties with the company. Oddly, he stayed on in a consultant role with a $46 million salary. Today, after some downsizing, which included slower growth plans and ending free beer at its North American locations, WeWork finally went public in 2021. Not via IPO, but through a special purpose acquisition merger, or SPAC. Today, WeWork trades at around $6.82 per share, down from an all-time high of $14.98 and off roughly 26% year to date. Interestingly, there's some optimism on Wall Street, some of it as recent as the past week. Piper Sandler suggests buying WeWork stock, saying the company could turn a profit within 2 years. This would be quite the accomplishment given WeWork lost $4.6 billion in 2021, up from a $3.8 billion hit in 2020. This didn't stop another analyst firm, Mizuho, from arguing WeWork stock could double over the next 2 years. They say WeWork will benefit from the post-pandemic work transition to more flexible and hybrid models, and there is data to back up this optimism. WeWork's 2021 membership includes 63% of Fortune 100 companies. It has enterprise deals and partnerships with major names, including Cushman & Wakefield and Hudson's Bay Company. At its 756 locations across 38 countries, WeWork membership does trend enterprise and long-term. Current WeWork management has obviously shifted focus from the founder's original idea of bringing individuals together to create community. Like a kibbutz, if you will, to a more traditional corporate-skewed co-working model. It's worth noting that WeWork doesn't show up in our proprietary Trackstar data of the stocks investors are searching for, including in the real estate services category. This just might mean it's truly flying under the radar. The bottom line is this. We'll keep an eye on WeWork here at The Juice. The Wall Street upgrades might be jumping the gun, particularly when you consider the company's massive losses. That said, if WeWork belongs in your portfolio at all right now, it belongs in that speculative segment we love to talk about. That 5% or so where you keep the stocks with huge risk but equally as large reward potential. Ones where you see the potential for the type of turnaround stories that can generate meaningful upside, such as a double or better. That's all we have time for today on The Juice. Click follow and subscribe to The Juice email for your daily dose of market minerals.